Imagine a world where a single tweet, a Reddit post, or a YouTube video can shift billions of dollars within the stock market in a matter of hours. Today, that's not just a fantasy, it's a reality. Social media's influence on the financial world has grown into an undeniable force that's reshaping the dynamics of stock trading, allowing ordinary people to disrupt a system once dominated by the biggest players on Wall Street. Platforms like Reddit, Twitter, and even TikTok have empowered retail investors by making financial information widely accessible and by facilitating community-driven action on an unprecedented scale. Through collective movements and online conversations, these investors have managed to trigger massive shifts in stock prices, as seen in high-profile cases like GameStop and AMC. This video will explore how these online communities wield a new kind of market power that challenges traditional financial systems and blurs the lines between professional and amateur trading. To appreciate the full scope of social media's influence, it's important to understand how the stock market has traditionally operated. For decades, professional traders and institutional investors held a significant edge. Supported by teams of analysts, access to exclusive data, and a deep understanding of market trends. Meanwhile, individual retail investors, typically with fewer resources and less information, had relatively limited sway over the market. But with the rise of social media, especially forums like Reddit's Wall Street Bets, everyday people have come together to share financial insights, build trading strategies, and rally around specific stocks with remarkable power and speed. Wall Street Bets, in particular, became a hub for people interested in meme stocks, or stocks that attract attention not necessarily due to their financial fundamentals but because of the hype and community support surrounding them. The GameStop phenomenon, where a collective of Reddit users orchestrated a short squeeze on hedge funds that had bet against the stock, marked a turning point. Thousands of Redditors purchased shares in GameStop, defying traditional market expectations and driving the price up dramatically. This short squeeze strategy forced institutional investors who were betting on GameStop's failure to buy back their shares at a loss, pushing the stock's value even higher and creating massive financial losses for some hedge funds. The GameStop surge didn't just make headlines. It sent shockwaves throughout the entire financial world. Major players on Wall Street suddenly found themselves outmatched by retail investors who were armed only with social media and mobile trading apps. AMC followed a similar path, with online communities backing the stock and inflating its value beyond traditional expectations. In both cases, investors weren't just looking to make a quick profit, they were challenging a financial system they felt had left them out for too long. Social media acted as the catalyst for this uprising, allowing individuals to organize MSA, coordinate their trading strategies, and create viral narratives that drew more people into the movement. The accessibility of information online meant that anyone with a phone could keep up with the latest developments and act on them instantly. The power of online communities lies in this rapid, decentralized communication where information and excitement spreads in seconds, making it possible for retail investors to act as a collective force. This unprecedented movement reflects the influence of collective decision-making, where hundreds of thousands of people make decisions based on the opinions, emotions, and excitement of others. Emotions play a significant role here, with FOMO, fear of missing out, driving many people to join these movements. When a stock like GameStop or AMC starts trending on social media, a sense of urgency and excitement builds up, pushing more people to invest quickly before it's too late. This creates a feedback loop where the more people join in, the more the stock price climbs, encouraging even more people to jump on the bandwagon. However, this approach also brings inherent risks, as inexperienced investors may not fully understand the volatile nature of these stocks and could suffer significant financial losses if they buy in at the wrong time. This volatility, while thrilling, also contributes to a destabilized market as stocks rise and fall based on social sentiment rather than company fundamentals. The ripple effects of these trends extend beyond the stock prices of GameStop and AMC. They challenge the established financial hierarchy and put institutional investors on notice. Hedge funds, which traditionally held an advantage in the market, found themselves on the losing end of these social media-driven campaigns. The sudden power shift forced many institutional investors to rethink their strategies, as the retail investors they once overlooked demonstrated their capability to influence the market. As a response, regulators have begun paying closer attention to the influence of social media on the stock market, raising questions about how much control online communities should have and whether new regulations are necessary to protect inexperienced investors from potentially devastating losses. With this new era comes a complex landscape where the pros and cons of social media's influence on the stock market are fiercely debated. On the one hand, social media has democratized financial markets, allowing individual investors unprecedented access to market information and decision-making power. People who previously felt excluded from the stock market are now participating in record numbers, fostering a sense of empowerment and engagement. On the other hand, the downside of this empowerment is the volatility it introduces, as stock prices soar and crash based on social sentiment rather than economic fundamentals. Moreover, the risk of misinformation and manipulation in these online communities is a serious concern. With no gatekeepers controlling what's posted, some individuals may spread rumors or false information to sway stock prices for personal gain, a phenomenon that regulators may find challenging to address. Looking to the future, it's clear that social media's influence on stock trends isn't just a passing fad. As online communities continue to mature and grow, we might see further shifts in market dynamics, and potentially an evolution in the relationship between Wall Street and Main Street investors. The increased regulatory scrutiny will likely shape how these online communities operate, potentially leading to more rules designed to protect investors from the market's wild swings. This raises the question, are we witnessing the beginning of a new era in financial markets, one that democratizes wealth creation, or are we simply opening the door to greater risks and market instability? To wrap up, we've seen that social media's influence on stock trends isn't just about money, it's about power, community, and the potential for change within one of the most traditional systems in the world. What do you think? Is the power of online communities a positive force in the financial markets, or is it too risky? Share your thoughts in the comments. This conversation is one we're all part of, and it's reshaping our understanding of money, markets, and the role of the individual investor in a rapidly changing world.